Hello, everyone. Today on the Final Bar, we'll talk about this market continuing to push onward and ever upward. The market goes to the sky and beyond. Apple, now a $3 trillion market cap stock, and that's just part of the story with the AI-driven frenzy continuing to push risk assets higher, particularly the growth areas of the market. But it's not just growth. We'll focus on a couple other sectors today, also making a new high to end the quarter. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the power of StockCharts. The StockCharts platform was designed to empower investors to better understand the markets, to better learn the lessons of market history, and better be prepared for whatever is to come. I think technical analysis is all about recognizing what's happening, focusing on what's working and what's not working, and really identifying and anticipating some of those inflection points. In a bull market phase like we've certainly been in here in 2023, particularly in the second quarter as we bring it to a close today, you have risk assets pushing to the upside. Now, on a day like today, the end of June, end of Q2, pretty normal to have what's called window dressing. This is the end of the quarter. This is when professional money managers have an opportunity to sort of make things look really good and demonstrate that, yep, we've been in the right trades. And so things that have worked often sort of work. A lot of times there's a rotation to sort of an ideal configuration for the portfolio. And then any sort of crazy bets they might have taken, they can re-engage them after the 4th of July holiday. So certainly part of the rally that we saw through the course of the day today, you could attribute that to sort of quarter-end window dressing. Next week, of course, you have a light day on Monday, holiday on Tuesday. Then we sort of get back to normal, whatever we're going to call normal in 2023 in the middle of next week. For now, you're seeing the growth areas of the market like technology, consumer discretionary continue to press the long side, continue to push higher with higher highs and higher lows. What sort of signs, if any, do we recognize about those trends abating? Let's get to our Wrap the Week segment. We'll try to dig into those themes the best we can. I do want to start with a poll question, by the way. We always have a poll running on our social media accounts on Twitter. Also, of course, subscribe to our YouTube channel. You won't miss one of these polls. And we asked you recently, in your opinion, what's the probability of the S&P 500 closing above 5,000 on the last trading day of 2023? And this question is meant to kind of get you to think more probabilistically, if that's a word, right? Instead of thinking of, here's my answer and it's right, I know the S&P is going to be above 5,000, think about all of these as different possibilities, right? What's the likelihood of that happening? And then you can think about how to handicap that or how to, what are the odds of that happening? And then think about how you might want to be positioned given that as a potential outcome. Most of you, actually not quite most, but almost 50% of you said below 30%, basically saying incredibly low likelihood that the S&P gets to 5,000. Now, of course, getting to 5,000 means it first needs to make new all-time highs, pushing above 4,800. That on its own has seemed very unlikely, but weeks like this and months like this and quarters like this certainly open the door to 5,000 being a number that's getting closer and closer, right, as we look above the current levels. So, for now, I would say it's an interesting sort of discussion. I would probably go more in the 30 to 50% angle, I think, only because there's a reasonable likelihood that it's going to happen, particularly given the strength that we've had. The question is, what sort of pullback do we have? When does that occur? And then what sort of strength do you get in the fourth quarter? I'm not sure if it's going to be enough to get us to 5,000, but thanks you guys so much for going through that thought process and thinking about what might come through the end of the year. Let's continue our Wrap the Week segment, just looking on what happened with the major averages today. The S&P having a decent up day, pushing into the close just above 4450, more toward the highs of the day. Really nice rally through the course of the day, sort of stayed elevated going into the closing moments, up about 1.3% from Thursday's close. The NASDAQ composite leading the way higher, up 1.5%. The Dow up about 0.9%. Worth noting, mid caps pretty good, hanging along with the Dow. The S&P only up 0.2%. So it's an interesting thing because one of the things that we've been talking about with a lot of our guests is sort of this idea of narrow leadership, which I think was an obvious truth a couple months ago, right? It's sort of like the mega cap technology consumer names and then everything else. And there's this big dispersion between those. Now, those leading names have still really outperformed everything else. but you're starting to see some breadth conditions really start to improve. Small caps on a day like today, not really having that sort of move. And again, I think that's part of the window dressing sort of thing. Any sort of really crazy speculative bets you might have made as a money manager, now's your time to sort of right that ship and make sure when you lock in your holdings at the end of the quarter, it looks just like your clients might expect it to. Then you could go back to doing some out of benchmark bets that might be a little more speculative with greater risk, but also greater potential return. So pretty common behavior here for the end of the quarter. But something to watch would be the underperformance of small caps. That's not usually a great sign for risk assets. The VIX continues to go lower. The volatility picture continues to show this is a slow and steady uptrend in a low volatility environment, very much like 2021. But these VIX ratings are actually lower than we were through all of 2021. This is going back sort of pre-2020, back to like 2016, 17 sort of numbers. If you look at a long-term chart of a dollar sign VIX on our platform, you'll see what I mean. The VIX used to be pretty common between sort of that 10 and 20 range. We've been incredibly high recently in the last couple of years. Looking at some other asset classes here very quickly and seeing what we can see. The yield curve overall moving lower. So the long bond yield, the 30-year around 386, 10-year yields around 382. With one of my guests this week, I forget which one it was, we talked a lot about sort of the interest rate environment. And actually, I think it was yesterday with David Cox of Raymond James. Really interesting conversation, just talking about how bond prices are sort of stabilized. What's the value proposition of owning a high-yielding defensive stock like utilities or consumer staples when you can get such a high interest rate on a CD, right, or on other sort of income-generating part of your portfolio. So the value represented by some of the defensive sectors a little less attractive than when interest rates are at zero. So for now, interest rates coming off a little bit, bond prices pushing a bit higher, might be another thing to think about in the coming weeks going into that Fed meeting in July. The dollar index, not too much of a change, down about 0.4%. That's using the UUP, which is a bullish dollar ETF. Continuing on here, the commodity space, the DBC up 0.8%. That's a broad commodity ETF, really with a bit of an energy sort of weight in it, but really covering a broader scope of the commodity space. Precious metals all in the positive. So you have gold and silver both up about 0.7, 0.8%. It's actually a surprising strong day given the fact that equities, other risk assets are moving to the upside. These are a little more defensive, but also doing just fine. Energy prices moving higher. The only thing that was down was corn, which is a two-cream ETF that we show there. Finally, in terms of the cryptocurrency space, Bitcoin down just slightly. All the other top 10 cryptocurrencies that we track on our platform, all in the green. Bitcoin's still holding steady around 30,000 to 390, we'll call it 390. Ethereum prices just below 1930, so still below that key 2,000 level, which is a level we've talked about a number of times here. Let us show the wrap the week charts. This is a chart I like to show, which just looks at how the picture has changed from last Friday to this Friday. So we'll start the clock on June 23rd, last Friday's session. We have this week ending in today's close. What happened to major markets over this time? What's really interesting this week is that the S&P was one of the top performers, which has actually been a little unusual here recently. There's been a little more chop, a little more differentiation, but for now, the S&P having a pretty strong week, finishing the week up about 2.3%. Only one thing outperformed. That was actually the Russell 2000, which finished up about 3.7%. That's the IWM ETF. Everything else underperformed the S&P. In pink and in brown, we have the NASDAQ 100 and crude oil prices, which ended up being right about the same, around 1.8 to 1.9% higher for the week. This is emerging markets up 1%. That's the EEM is that ticker. And then here, flat for the week, the dollar and gold. The dollar came off a bit today. Gold rallied in the end of the week. Both really didn't move anywhere. They sort of neutral and unchanged for the week. These underperformed, actually were down on an absolute basis. Bond prices finished the week down about 0.4%. And Bitcoin, after having an incredibly strong week last week, this was, dwarfed all the other returns when we were doing this session last Friday. Bitcoin actually down 1%. So still coming off of a pretty nice rally last week, but giving back some of those previous gains just slightly. Let's look here at a chart of the S&P 500 and just focus on what happened today and what that means to the big picture. New high for the year going into the end of the second quarter. I would not say I'm surprised given what we've seen so far this week, right? Coming out of last weekend. You've seen a series of higher days pretty much every day this week. After Monday, we've closed higher than the open. It's been a nice accumulation period pushing to the upside. An uptrend, as we talk about many times, Charles Dow over 100 years ago sort of created this concept of trend following, to be honest with you, and defined that as looking at highs and lows over time. What is the trend in the extremes in the price movements? And a day like today, making a new high for the indexes for 2023 sort of completes that sort of Charles Dow approach, Dow Theory 101, which is we keep making higher highs. When we pull back, we make higher lows. Now, the level we've talked about recently is sort of looking at potential support. When we rolled over the last couple weeks, sort of made that new high around 44.50. This was a couple weeks ago, and then last week kind of coming down. We talked about 4,300, and that is essentially the big round number here at the lower end of this pink shaded area. It sort of lines up a couple points. That's a Fibonacci level that we've talked about in some of our longer term analysis. It's also the August 2022 high, all sort of in that 43 to 43.25 range. We touched the upper end of that going into last weekend, and one of the things we talked about was, does this level hold, right? The main question to ask is that line in the sand question. Do we keep that line in the sand? Do we hold above that level? This week, the answer has been absolutely, right? Instead of failing at 4,300, instead of pushing lower and starting to make us think about further downside support, we're actually bouncing just fine, regaining all of the losses from last week and just a touch more. So today, closing right at 44.50, right at the high from 2 weeks ago. At this point, we're retesting that level. The strength is there, right? And you can see the strength based on the trend of this chart over time, continuing to push to the upside. Where else can we go here? I'll tell you what, let's look at the sector movements today and just focus on what we learned today. The technology sector and consumer discretionary, number 1 and number 2. Tech was up 1.6%. The XLK continuing to show strength. One of the top performers year to date, continuing to hold that sort of top tier recognition. Utilities were number 3, which is just a slight head scratcher that you have this nice up day and then kind of a defensive low beta sector like utilities number 3, but that's where we're at. On the bottom, 3 sectors at the bottom were real estate, energy, industrials, financials, about the same. All of those still positive, though. And the worst performer, real estate, was still up about 0.5%. So you're certainly getting that sense that a rising tide lifts all boats. You're getting that in a day like today. I want to do something a little different today. We have this really cool way you can visualize a portfolio or a chart list using what's called the performance view. So if you look at your lists, go to View As and click Performance. Now, this is a tabular report. It's just showing you a quick table looking at different time frames. But I found at the end of the week, at the end of a quarter, it can be really, really helpful to just see where we've come from and just get a sense of where we're at. I'm sorting this by the 5-day performance. So basically saying from last Friday to this Friday, what happened? And if we sort that list, you can see the top performing sector over the last 5 days. Guess what? It wasn't technology. It was real estate. Number 2, energy. Number 3, materials. So those growth sectors, I think we're so used to that narrative of growth kind of working and everything else sort of not working or underperforming. This week, which is sort of where the technology sort of feels like the growth trade is reinitiating that uptrend, reasserting its leadership position, REITs actually had the best week of all, followed by energy, followed by materials. So you're starting to see some of these cyclical sectors, usually more late cycle leadership, we'd call them, starting to really perform pretty well. I would argue that the bull case from here, I don't think it's just Apple continue to go higher, although that certainly isn't going to hurt. I think it's some of these other sectors starting to do better as well. I think it's things like industrials and materials and energy, things that have been struggling on an absolute basis, starting to improve. And you're seeing some swings higher across the board in those areas of the market. Now, when you look at the quarter, when you look at Q2, think about the end of March to the end of June, certainly tells a story about the strength in growth stocks. Technology, consumer discretionary, communication services, number 1, 2, 3. Now, again, these are cap-weighted ETFs, so it's really leaning towards the biggest names out there. But you can see that the XLK, the technology sector, up 17%, followed closely behind by consumer discretionary, and communication services having a decent quarter as well. So, if you wanted to do well relative to the benchmarks, in the second quarter of 2023, it was simply own large cap growth, and you did exceptionally well. Year to date, that's been an incredibly powerful strategy as well. You can see this column here, year to date performance, showing how these sectors are really dominating that. And some of them, of course, still down for the year. So some of these sectors still below the waterline, right? So utilities, energy, healthcare, financials, even with some bounces in the month of June, still a negative return year to date. Now let's look at a couple of these sectors in a little more detail, just talk about some of the movements that we've seen. You know, energy is such an interesting sector. I asked a couple of my guests about energy. Any opportunity I could, I sort of threw that out there just to see if I could get a bite, see if anyone would say, yep, energy is the #1 idea. I didn't really get anyone saying anything like that. I think that might be an indicator on its own. But I did want to highlight the XLE might be at a really compelling position here. Let me zoom into like the last year or so. And you can see the move that we've had in energy. Of course, the XLE sort of having this double topping pattern in November of last year, again in January, and then started to rotate lower. Here's where we get a big lower high in April. Now, of course, in June, we're well off of those all-time highs. But simple trend line analysis, if I just take let's see, the high here and connect it to this high here. I'm doing the world's faintest line. I apologize for that. Let's make that a little thicker and we'll make it a better color. There we go. So if we connect a trend line using the January high and the April high, you can see we're right about there. We're almost there. The 200-day moving average, kind of right around that same level. It's right around 82.50, we'll call it. For the XLE. With this nice bounce that we've had this week, we're getting closer to that level. At some point, when a chart's in a downtrend like this, connecting the highs with the trend line, you eventually break up. And that is a really compelling point to watch for, right? And the way that I think of it is we already know that energy is going down. We know that the price has been deteriorating. So we don't need a trend line to sort of confirm that it's going down. I want to have an indication that that downtrend is over and that we're actually starting to break higher. And I think this might be an important one to watch. Also look at the momentum. We've talked a lot about how in a bearish phase, the momentum stays sort of lower in the lower end of the range. The RSI rarely gets above 60, and we saw that at the end of January. We saw that at the beginning of April. We saw that really in early June, and we're right back there as well. So I think the bull case for energy, besides some of the individual names like DVN and FANG and Chevron starting to improve, it's also the XLE breaking above this trend line that has really been the story of the last 6 months, and the momentum picture improving a little bit further than it has so far. XLK, right? So talk about a very different picture. When you look at the XLK, think of this as a three-part chart, right? You have the uptrend in 2021, the downtrend for the first 3 quarters of 2022, and then the uptrend that has been there for the last 8 or 9 months. This has been a classic sort of trend-following dream of just watching this trend of higher highs and higher lows continuing to the upside. One of the things that I would tell you, because again, I often get questions like, where is technology going to end? So you have 2 options with something like this, a trend that is just working and just doesn't stop working. You can either project a high, right? So say based on what's happened, based on the height of this pattern, or based on a Fibonacci projection, here's where we may expect an upside objective, or you can put on your trend following cap, which I hope you have one, put that one on and just ride this and be happy that the trend continues until it doesn't. The chart will tell you when the trend is no longer in place. So one of the things you can do is just start drawing trend lines from these lows. The first trend line I would draw is from the October low and the January low. Now you've seen what happened is we've gotten really far away from that. So what you do is draw a second trend line using the next lows. You can see we've gotten a little bit farther away. So we draw a third trend line, and let's take it here and we go there. And I would say at this point, keep accelerating these trend lines. That's what this technique is called, accelerated trend lines. You keep following it higher at the third point, which is probably wouldn't draw any more than this, but at some point, the trend as you've defined starts to change. And we often talk about a change of character. When is a trend in place and then it's different? That's the sort of thing I would be looking for in a leading sector like technology. We're going to cut back here in a minute and answer some questions from the Final Bar mailbag. It's always a blast to hear from you and answer some of the questions you're running into. Before we get there, as a reminder, 2 things. Number 1, our mailbag is fueled from people like you sending in your questions. What are you running into as you are trying to put on your technical analysis routine cap and answer questions about the markets? Shoot us your questions via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. And of course, on the YouTubes, just put a comment below the video that you're watching. We'd love to hear from you. We'll hope to answer your question on our next mailbag coming up next week. And by the way, Monday and Tuesday of next week, we have some really special editions of the Final Bar. I sat down with Grayson Rose. We both shared with you 5 stocks to watch in July of 2023. So between the 2 sessions, we'll have the top 10 stocks to watch. Don't miss that coming up on Monday and Tuesday for the Final Bar. Let's open the final bar mailbag, shall we? Again, thanks again for all the questions that you brought in, all the thoughtful ideas and things that you're looking for. Here's question number one. Dave, shorts have now reached the $1 trillion mark. What does that mean for stocks? That's a really interesting question. I have not independently validated your point. I'm going to assume what you're saying is true and that shorts, and I'm assuming that's like a market-wide, like a broad index of total short interest is over $1 trillion. Boy, that sounds like a lot, but numbers sound like a lot these days. If Apple's at a $3 trillion market cap, maybe that's about right. Maybe that's about where we should be. But no doubt that shorts are pretty elevated, and on certain names, certainly way more than others. So when the market goes significantly higher, what happens is you have people that are betting on mean reversion, betting on that trend to be over. And basically playing a short trade or playing the short side of the market is not just saying, I want to get out and wait for the price to come down. It's saying, I want to actively make a bet that down move is going to happen now. And what you have to remember is it's sort of like an options contract. It's not structurally, but mentally, I think it's the same thing. You're basically assuming that the price is going to go down before it goes up so much that you're going to have to cover your short and that your broker is going to call and say, we need you to deposit way more money because you're losing so much on this position. Shorts are often done with margin accounts, and so there's all sorts of challenging issues you may have to run into if the market moves against your position. Here's what I would say, two things. Number one, what does that mean for stocks? You know, generally speaking, you look for areas of the market with high short interest. You assume that those shorts, you assume a couple things. Number one, high short interest often presents the opportunity for what's called a short squeeze. And if you've not heard that before, click the magnifying glass on StockCharts and search for that term. You'll learn a lot about what happens when too many people are short. They all get caught underwater as the price continues higher, and eventually they have to cover their short trades or make adjustments or buy back the underlying stock. As a result, that creates further upside pressure, and here's a sort of feedback loop, a positive feedback loop. As the price just continues higher, because the price moves higher, that traps more shorts, squeezes them, they have to cover, that creates more upward price movement and so forth. Phil Erlanger, who was at Fidelity before I was, this was like in the 80s and actually the 90s, if I remember right. Phil actually made a career out of looking for what he called the Erlanger short squeeze, looking for names that were where there were too many people short. So I would say, to be honest with you, the fact that there's a lot of shorts is probably a bullish sign for stocks, because think about what happens right now if you're short Apple, which I can't imagine wanting to do in the face of a mega cap, freight train coming at you and you basically standing on the track and saying, no, stop, Apple, don't go any further. That's kind of what I think it would feel like being short Apple. So I would say that's probably a bullish sign that there's so much short interest, because alleviating shorts and people getting caught there, that short squeeze can provide a lot more upside opportunity. The other thing I would say, the challenge about shorting stocks, it tends to work in a very small period of time. If you look over the longer history of the equity markets, they go up because the economy is growing. We have population growth. Global economies are becoming more and more developed, and there's so much upside potential for humans on the planet. And as a result, that's why numbers keep getting bigger and indexes keep going up. When you're short, you're fighting against all of human history. And so that's going to work in a short time frame. That's going to work in a tactical point of view. But long term, it is rarely and literally never has been a good idea over the long term. And that's what I would say about the high short interest right now. Thanks so much for asking about that. Maybe think a little bit about what the implications may be. Question number two. I am not a professional by any means, but is this a cup and handle pattern for Charles Schwab, SCHW? So number one, don't ever be afraid to say you're not a professional. I don't know if being a professional is a good thing necessarily, because there are a lot of blind spots that professionals have. And I'll tell you, having spent much of my career working with professional investors, they are not perfect and don't have all the answers, as much as they may want to imply that that's the case. But having said that, is this a cup and handle pattern for Schwab? And this was the chart that you sent in. I appreciate that. As a reminder, if you're sending in a question, the best thing to do is click on this little permalink button below the question, because then I can see the actual link. I can see the live version of the chart that you're asking about. On ACP, all you need to do is on the lower left, click share, and then you can share the active chart, whatever chart you're highlighting, or your entire layout. So if you have multiple charts you want to ask about, just click there, the little arrow, share layout. Again, that'll give you this little hyperlink. Just copy and paste that link into an email. I'll be able to look at exactly the charts that you're asking about. Getting back to Charles Schwab, is this a cup and handle pattern? So I would say yes, but not an ideal one, I guess, is the way that I would answer your question. And so, is it a cup and handle pattern? I would say, based on a loose definition of, do you have a rounded bottoming pattern? and then a shallower sort of short-term pullback here, and then a breakout. It has all of those three things. And those are the three main components, sort of the main part of the cup where the coffee's going, and rounded, sort of a rounded bottoming pattern, which I think is fair. A shallower pullback, this is the handle, right? That's why it's called a cup and handle. And then the third thing, which is why I'm glad you asked about this chart, is the breakthrough, right? Until the trigger, right? And the trigger is until we break above that rim of that cup. Until that happens, it's actually not a completed pattern. Oftentimes I will have people say, is this a head and shoulders top right about here? And I have to say, it might be, but you have to wait until a break of the neckline. That's what confirms that that was a head and shoulders top. And this is actually a great example on the Charles Schwab about that breakdown really validating that negative trend. Now, why would I say but not a perfect one? Two things that concern me about this being a textbook cup and handle. So a real good cup and handle pattern has a real rounded bottoming pattern. It doesn't have this sort of weird thing happening in the middle. This is almost a little more like a head and shoulders pattern, to be honest with you, because you have a head and a lower left shoulder and a right shoulder. So it's sort of weird in the middle kind of pattern. But to be honest, I'm not as much of a stickler for that. I would say you've identified a clear resistance level and a clear break, which I think could be certainly compelling. The other thing, to be honest with you, a lot of people think of cup and handles this way. After a sell-off, cup and handle patterns are actually more intended to happen after a rally, right? So you have a big run higher, then you have the rounded bottom, and then you have the handle. That is sort of the Bill O'Neill classic cup and handle pattern. So while I would say, yes, I think you've identified a decent example of that, and I think the fact that it's broken above resistance makes $56 a pretty important level that I think you've identified. Is it an ideal one? No, for those couple of reasons that I highlighted, and I hope that helps you make sense of that would be. And again, cup and handles are usually best identified in an uptrend, a big run, and then this is that consolidation pattern where people initially take profits, new buyers come in, and then they're willing to pay more, and that's what completes that pattern to the upside. Great question, by the way. Next one. Does Microsoft provide a good example of a negative divergence using the PPO indicator? And you also sent a link in. I appreciate that so much because I'm looking at the live version of the chart that you asked about. This is your chart of Microsoft. We're looking at the higher highs in January and then the bearish divergence with the PPO indicator. 100%. I think that's absolutely a bearish divergence, or what you call a negative divergence. What's interesting, I don't use the PPO as a primary indicator. I don't have it on all of my charts. I often bring it up, as you probably know from watching the show. I always have RSI on my charts, and there actually is not a divergence right now with RSI. A lot of these big growth names have not had that divergence yet. A couple have, like AMD has, and a couple other random ones, but on average, broadly speaking, Apple, Microsoft really haven't. They're showing strength on higher momentum. But you've identified an indicator, PPO, which is actually showing a bit of a negative divergence. Divergences can be found with a number of different indicators, to be honest with you. I use it most often with RSI, but MACD or PPO is a really good way to do it as well. And if you're not familiar with this indicator, again, with anything that I'm showing that you're not familiar with, click the magnifying glass and just type PPO or MACD, and you'll get more information about what the indicator is, how it's calculated, what the signals are, and examples to show you sort of ideal versions of what you might be wanting to look for. But just the quick version is MACD stands for Moving Average Convergence Divergence. It is a classic trend following tool, basically taking two exponential moving averages, looking at the difference between the two, and just looking at how those signals fluctuate, swinging up and swinging down. It's a classic trend following technique, widely followed in the industry, and certainly I think well worth your time as just a systematic way of identifying price swings. PPO is basically an adaptation of that, and I feel like earlier this week, I want to say we talked about the PPO, and I showed a deeper history of how MACD and PPO are a little bit different. But basically, the PPO stands for Percent Price Oscillator. Does the same thing as the MACD indicator, but it uses percentages instead of absolute prices. It's just a little easier to look at deeper history using the PPO, but the indicators are almost identical. The signals are very, very similar. So the fact that we're seeing higher prices on weaker momentum using the PPO, nice catch. I hadn't actually seen that until you asked that question, and I appreciate it. So you asked what's next, or what does this mean? So what I would say is I think of indicators like a divergence, like a negative divergence, as a bucket of indicators that I think of as leading indicators, right? Some of the technical toolkit is telling you something might be happening. These are called the leading indicators. Some of them are lagging indicators, more confirmational. It tells you that thing that we just saw, that was the top or that was the bottom, right? Those are more, doesn't predict what may happen next. It actually confirms something might happen. And then we have other ones which I call more structural indicators. Things like, breadth conditions maybe where it could happen anywhere along that cycle. But it's just telling you things are sort of shifting. And ideally, you combine all of those, right? You have some leading indicators that tell you something is, red flag, something might be happening. You have some lagging indicators that tell you, okay, yep, that actually was the case. And if you haven't taken action yet, you need to make sure that you do. I would say with a chart like Microsoft, you've sort of triggered the red flag here, right? You've a leading indicator, the divergence has occurred. We're seeing the price continue to go higher, which on the surface seems bullish, but we're starting to see the momentum slow down a little bit. Well, so here are two things you can do. If you want to be really aggressive about it, you short or you sell or you take an action because of that divergence, and then you basically just have a stop in place. So if that was wrong, and if you didn't perfectly time the top, then you can get out with minimal pain. Or this puts it on a watch list, and you wait for the confirmation to tell you things are going to go lower. That is more how I tend to invest. But again, it's really more about you and how you're wired. So I would say things to look for would be a lower high, right? If we rally here, now that we've had that divergence, do we put in a lower high around 343, 344? That would complete a potential rotation lower. Breaking down through moving average support, I think also would be an important thing to look at as well. Great chart, by the way. Nice catch with the divergence. And thanks for asking about the PPO indicator. Next question, how do you gauge potential rewards versus risk taken for a trade? It's funny, I don't talk a lot about risk versus reward on the show, and I'll explain why in a moment. But I will tell you that having taken the CMT exams, which was a big learning curve for me just a couple years ago, I remember going through and you talked a lot about risk versus reward. And a lot of traders, particularly like CTAs, really think about the market or think about trades in that sort of framework. And some of the people that I bring on the show go back to my conversations with like Joe Rabel, Doug Bush from ChartSmart, it comes to mind. He will often show, all right, this is a 3 times upside potential with a 1-time downside potential, so a pretty good risk versus reward. Jeff Hughes often does a good job of highlighting that risk versus reward scenario as well. We'll look at an example, something like Tesla maybe would be a good example of this. So what you generally want to do with something and thinking about risk versus reward is what you're basically doing is what's the upside potential versus the downside potential? How much do I think I could potentially gain versus what I would potentially lose? And if it's like a 1-to-2 ratio, meaning you have upside of about 1 times versus 2 times downside, that's not a great trade because it's there's a much bigger potential for loss than there's a potential for gain. If you're looking at Tesla as more of like a swing trade kind of short-term play, right? Think about what this chart looks like. You have resistance pretty well established here around 310. We just bounced off of 240. So if I would take a position today, for example, not a recommendation, but let's just for example purposes, let's assume we bought Tesla today. How would I look to the left and think about support and resistance? Well, we have potential support at 240. So maybe that would be my stop. So I have a $20 downside to my stop. And then we have upside to 320. So it's about a $50 gain. So a $50 potential gain and a $20 potential loss. About a 2.5 to 1 risk versus reward ratio. Not too bad, or really reward versus risk, the way I described it. Not too bad. Now, the problem is, so that is how you would generally do it. And I think there are a lot of ways to do it. You can use average true range, use whatever natural technique you would use for trailing stops or something. But it's basically where you think it might go versus what the likelihood or how far we might go to get you out of your trade. Where would your stop be? And just make sure that it's an attractive enough opportunity. The problem with that, and the reason why you probably haven't heard me talk about it too much, is because a lot of stocks have already run so much, right? What's the risk versus reward for Apple? Well, I don't know. The risk is pretty far down because we just kept going up for months and months with no real pullbacks to draw from. The 50-day moving average is another $20 below current levels. That would be a pretty big drop just to get down to the 50-day moving average because it's run up so much to the upside. The other problem, what's your upside objective, right? How do you calculate an upside objective with a stock that's already at new all-time highs? Well, you have to use not traditional resistance levels. You actually have to look way further and do some projection technique to go up there. So overall, when stocks are doing well, I tend to think more as a trend follower. I'm just going to assume that the trend is in place until otherwise. And that's why we don't talk about risk versus reward as much with names like Apple. But again, I'd go back to some of the conversations I've had with some of the experts that I just mentioned, because they do a really good job in our interviews of highlighting that risk versus reward, which I think is really well done. Last question, then we got to be done. What's the best way to start research into emerging markets? Kind of a meaty question, so I'll give you a brief answer. Tom Dorsey, I met with him years ago. We were at a conference, and I got to sit down and talk with him about a lot of things. And he shared this story about being an early investor in Russia. This was like early on, before the Russian markets, and now, of course, closed, so not a great example maybe, but this is when Russia was very much an emerging market, and it was unheard of for investors outside of Russia to have any exposure. And he literally picked up the phone, found a broker in Russia, and opened an account because he saw some charts that he liked, and he wanted to actually buy some stocks. And so he literally had to call a broker in Moscow and figure out how to wire him money and do all of that. What's funny now is that seems so antiquated, right? You have the ability to transact all over the place, and not just in local markets, with ETFs, with ADRs, with U.S. listings of non-U.S. stocks. There are a lot of opportunities to invest in emerging markets more than ever. So a couple things I would tell you, and maybe just two brief things to start you off. Number one, I would start with ETFs, because that's a really good way to understand what's happening out there. I have a watch list of global ETFs, and it starts with the big ones like EFA, which is Global Developed Markets, EEM, which is Emerging Markets, Frontier Markets, FM, and then a lot of individual iShares ETFs and a couple other families that are represented here as well, just focusing on the key global markets. Now, these are all in US dollar terms, and I say that because something like India, which is over here, is actually already to all-time highs if you look at the local indexes like the Nifty or the Sensex. But the INDA is not quite there yet, because it's including the dollar differential basically in the U.S. traded ETF. That's a good place to start, though, just to see how developed Asia versus developing Asia versus Latin America versus Europe, how those different buckets of stocks and what individual areas of the market may look compelling. I've often found ideas here that I wouldn't have found otherwise. The other thing I would say is remember that a lot of non-U.S. stocks have U.S. listings. Some of the better charts that I've seen in the financial sector, for example, are Latin American banks. This is ITUB, which is Itaú, which is a Brazilian bank. If you look, making all-time highs in the last couple weeks. Others like Banco Bradesco and Chilean banks and Argentinian banks have looked up particularly strong at times. So remember that you can use our scanning tool and basically just look for stocks listed on the NYSE or the NASDAQ, but the country is a non-U.S. country, and just pick some of the ones that you might want to look at. So if you see something that's strong based on the global ETFs, maybe use that as a tool to find some individual names that might be opportunities. I don't think you really need to go, although you can certainly invest in local currencies and open brokerage accounts. I would say nowadays with ETFs, with non-U.S. stocks listed, or at least ADRs, American Depository Receipts in the U.S., there are a lot of opportunities to own non-U.S. companies with upside potential today, right as a U.S. listed stock. That is it, folks, and that's a wrap for the show. We've got to go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. This is one that I simply call the chart, and I've highlighted this before randomly. Again, the quick story on this was years ago. I would have people say, what does the chart say about blah? What do the charts say about the markets? And so I jokingly would create something that I just called the chart. And I'd say, here you go, here's the chart, implying like all you need is this one chart. And what's funny is about once a year, maybe twice a year, I've taken what I've done and maybe add or subtract one thing. And I've often just thought of this as a great sort of cheat sheet. It's sort of like your quick cheat sheet, one pager for the markets. Overall, what are the conditions like? And these are the 5 things that I set up at the end of last year I still think are pretty valid. First off, it's looking at the S&P 500. And again, we're making new highs for the year here going into the end of the second quarter. It's been a strong second quarter after a strong first quarter with some notable pullbacks. But overall, the position of the market is strong on all time frames that I'm worried about. So overall, the trend, we have to follow that to the upside until proven otherwise. If there's any issue with this trend, it's the second item down, which is the advanced decline line. If you look at breadth using things like a broader universe like the New York Stock Exchange, it's not been as attractive, right? The equal-weighted S&P, not as strong as the cap-weighted S&P, and that's, again, just the nature of the biggest stocks doing a lion's share of the gains. Look to see if this continues to improve, and I think regaining the February highs would be a great bullish sign to have at the beginning of the third quarter. Other things to look at here in terms of breadth, the percent of stocks above their 50-day moving average, right around 74%. That's a bullish range. That's a bullish number. I'm looking to see if and when this gets above about 80%, because that's what happened at the August peak. That's what happened at the December peak of last year, and I'd be very interested as we sort of get to more elevated numbers of that range. The percent of stocks above, the bullish percent index for the S&P 500, currently around 67%. That's looking at the percent of stocks with a bullish point and figure chart. That's getting close to 70, which has often been the sign of an end to the move. And offense continues to outperform defense. I had a great discussion yesterday with David Cox of Raymond James with that one. Chart number 2, the AAPL survey, the bulls versus bears. We haven't talked about this too often recently. I just want to highlight that there's this big spike in bullishness about 3 weeks ago, and then it hasn't really changed. What's interesting is as the S&P is making a new high for the year, as the growth trade has continued to work, what this survey is telling you is the people that are all bulled up, and there's not any additional bulls coming in here. Sort of like a long and strong, we're happy, we're bullish, let's keep it going. If you look previously, you'll see times where the bullishness becomes way more elevated than this. Right? I would say this is strong, but not extreme. 42% isn't a bad number for a bull market phase. That's actually kind of normal. Elevated levels would be above 50% bulls. That's when you have to start worrying about there's too much bullishness, too much optimism, and now we're pushing prices too high. This is telling you arguably, there's more room to run potentially. Finally, 2 sectors finishing strong going into the end of the second quarter. The industrial sector and the materials sector. When I'm looking at the performances here over the last previous periods, I was surprised to see things like industrials and materials at the top of the list this week. You're seeing a lot of strength. The XLI just made a new high today. The materials sector, not a new all-time high, but certainly at the upper end of the range we've been for the last quarter. These are areas of the market that have been underperforming. They continue to do this. That is showing you renewed strength and potentially renewed opportunity. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, Monday, Tuesday of next week, top 10 stocks to watch for July 2023. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe. Happy 4th. We'll see you next week.